Well, this is the podcast for you if you are maybe 10 minutes out for 10 minutes or 10 years out from retirement, Martin. We just want to talk about a variety of questions. If you've just joined us, we get a lot of our questions from you, the listeners who write in via the Retire Right website or in our Facebook group. If you want to join the Facebook group and enjoy the conversation, I moderate that pretty heavily. We don't allow anonymous posts because we just think there needs to be some skin in the game so people don't say dumb stuff. I basically, if you're a rude a-hole, you'll get booted.
Later, trying to sell something or
self-promotion, any of that stuff. It's really a good group and it's a safe group. Still don't get advice from randoms on the Facebook group, but it could be a good way to, see which way the wind's blowing. And if someone says something, go, I wonder if that's applicable to me.
And same with these questions. If you're thinking it, someone else is as well.
Yeah. So put a question up in the Facebook group. If you want it, if you put it in the Facebook group and you don't want it read out on the podcast, just put anonymous if you read it on the show. But look, this podcast, it's got it all. It really has. And we're going to get into it today. We're talking investing, defensive asset allocation, aggressive growth. We're talking inheritances. What else are we talking about today? Transfer balance caps.
That's fun.
And investing inside or outside super. Martin McGrath from Financial Edge Group, thank you for being on the show today. You ready to press go?
Let's do it.
All right.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
Rightio. Pete, not seeking financial advice, followed by a but. But have you or your colleagues made or considering changes to your superannuation investment mixes? A few of my friends are making changes now in light of what appears to be overweight share markets, moving to a more defensive / less growth position or aggressive. I'm with Host Plus Index Balanced, which is 75% aggressive, 25% defensive, and has performed very well recently. However, with things looking a bit toppy, quote unquote, especially in the US, is this a sensible time to take Warren Buffett's lead and move something like the Host Plus Balanced defensive option for a little while, which has pretty much the same fees, 0.4 versus 0.5. Then, once the inevitable market correction occurs, whenever that is, move it back to my default index balanced option? Well, no, because if you do that, you've got the same outcome as if you didn't do anything. So, look, lots going on there, Martin. Do you want to pick that carcass?
Yeah, there's two parts of it. There's index
something
versus
on the side of the road,
non-indexed, and we might touch on that in a little bit around the volatility of those two options. But I suppose the main theme here, Pete's going, should I try and time the market? Am I sitting at home going, I think the market's overpriced, and therefore what I'll do is I'll sell today's price and assume that it's going to go down the next 3 or 6 months, and I can pick the right day that it's going to bottom out and I'll move back in so that when it rebounds, I've won. There's lots of charts and books and analysis to show that that is highly unlikely to be the case. So I'm not saying that you should never change your investment option, but I don't think the market conditions should drive that. It should be, what is my plan? If I am too aggressive, I'm going to make a change, but I'm going to make that change for the next 10 or 20 or 30 years, not just for the next 3 or 6 months. If my circumstances have changed, I know I've got to take some money out in 3 months to buy a new house, well, then I might change my investment risk. But timing the market is fraught with danger. and each to their own if you want to play that game, but it's not the game that we like to play. We like to make sure that your investments are set up for the long term and can ride out the ups and the downs of the long term.
Yeah, it took me when Pete said follow what Buffett says to move to conservative. I don't know if I've seen him say that, but what I just put into ChatGPT, has Warren Buffett recently said to move to conservative assets? And then the computer says Warren Buffett hasn't exactly told investors to hunker down in conservative assets, but his actions and comments lately reflect a decidedly cautious stance. Number one, a massive cash hoard. Berkshire Hathaway sitting on a record $348 billion in cash, US. They've sold a lot of stocks, taking money off the table. In the last 12 to 18 months, Berkshire has sold over 100 billion of equities, including big mega caps like Apple and Bank of America. Buffett continues to prefer treasury bills over long-term bonds. Their holdings are small and short-dated, reinforcing their cash pile parked in T-bills is a tactical buffer rather than a long-term pivot to bonds. He continues to push his famous 90-10 rule, 90% in a lower-cost S&P 500 index fund, 10% in bills. And the ChatGPT conclusion was like, so he says, quote unquote, go conservative, not exactly, but Buffett isn't urging people to flee stocks for safety. Instead, he's choosing caution with his own portfolio. And I think it's important, I've got my own self-managed super fund and my own investments in that. And, a lot of you out there have your own super funds that are managed portfolios by people. That's a long way from being the most successful investor in the world called Warren Buffett. And if he is, selling Apple and taking cash off the table, well, that's what he's done. It could mean that Apple's pretty hot at the moment and it's a good time to sell, but he's effectively a trader. He will, go in, buy companies, add value or whatever, and then sell. So I get what Pete's saying, and I just think we need to look at our own situation, Pete. How far are you from retirement? If it's more than 7 years, we're probably just leaving our portfolio, getting on with work and shoveling money into that portfolio.
Yeah. Yeah, and that's going to drive the greatest return. And I was just pulling up there to have a look at. I know a few months ago we recorded an episode. Depends on people listening to this. It might be further to 6 months ago. But Mr. Trump and his tariffs this year have created some volatility in the market. The market was down over 15%. The Australian market was down over 15% earlier in the year. And as we're recording today, up over 20% from that low in April. So if at that time you did go to the defensive option and maybe you hadn't moved back into the growth option, well, then that's 20% of return you might have missed out of. And I can tell you what, that when the market was at that bottom there, that's actually when it was the scariest. And that's a thing that it's easy in hindsight to go, oh, I could have timed that and today's hot and I'll know when the bottom is. But usually it's a case of the market actually starts to recover when things are still scary. And often as an investor, you're not going to have the gut or the balls to go and make that decision to go, oh, we're down 10% or 5% or 20%. I'll move back in today because it still looks scary. And all of a sudden you move back in when it's already recovered most of what it's fallen by.
The best thing you need to do with your superannuation is keep flipping mitts off it. That's what you need to do. Your friends, Pete, who are saying that a few of my friends are making changes now, if you do nothing, keep it in your portfolio. In 10 years' time, compare notes. I can guarantee by you not putting your mitts on it every 10 minutes and when Trump tweets, you will do better than your friends.
Yeah, and if you think that my portfolio is too volatile for me, then make that change, but make that change permanently. Now, going from a growth to a defensive is a big swing, but if it's going from a growth to a balanced, or every fund's got a different title, but if you go, hey, this level is just a bit too volatile for me, well, again, get some advice, do some research, understand that trade-off you're doing, but make that change you're going, I'm going to make this change for the next 20 years, not for the next 3 months.
A couple of things there as well. things, as you said, Pete, quote unquote, a bit toppy, especially in the US, you're invested in a 100% indexed option, right? That is going to have more volatility than the equivalent balanced option in Host Plus. And the reason why, daily prices every day. The balanced option, there is going to be property assets in there, there's going to be unlisted assets, there's going to be private equity that might not be listed. It's not going to have the same volatility.
Yeah.
Now, this is a good example of why cheap fees don't equal better or more return. As at the 30th of June, at the time of recording this, this is well after June, but the latest on their website, the after fees and taxes, so anytime you see superannuation returns and performance tables, the percentage, the 15% super tax has been taken out, and the portfolio fee has been taken out. The balanced option was 8.32% over a 10-year period. The indexed balanced option was 7.83%. So over the last 10 years, if you paid more in super fund fees, you would have got a better return. Now, you notice I didn't do it over the last 12 months because who cares? We're investing for over 7 years.
Super's going to be around here for a while.
And I'll have a look now because it might be more or less. The balanced was over the last 1 year was 10.81. The indexed balance was 12. So over the short term, sure, might be 2% more. But over the long term, you will 100% often have a better return by paying more fees.
And even with that, going back to 6 months, even shorter, the balanced is a bit over 5 and the index balance is around 4.5.
Yeah.
So I think that goes to probably my points around index investing is great and it's low cost, but it often is much more volatile.
Yeah.
The ups will be up, but the downs will also be down.
Yeah.
And so depends on what wave you want to ride. Even if we're getting to this same end result, and to your point, it's not always the end result, but even if we're getting to a 10% versus a 10%, how it gets there can be very different. And if you're putting in contributions along the way, do you want it to be swinging up and down as volatile? But also your sleep at night factor, the beta, or how the risk-adjusted return, all those things potentially start to come into play around, okay, I can get a 10% return, but at one point it might be up 30 and the other point it might be down 30. I think I'd prefer a 10% that the maximum might only be 15%, but the minimum might be minus 15%. I think I'd probably prefer the second option where it doesn't swing as much, it's not as volatile.
So to your question, Pete, have you or your colleagues made or are considering making changes to your superannuation investment mixes? The answer for me is no. I've got my investment strategy over the next 30 years, 25 years, 10 years. If you're investing for over 10 years, you just need to get to the place with your risk profile and emotion that you're in a growth asset mix. Because when Liberation Day happened in April and the markets tanked, that couple of weeks or the month when it was low, your employer is putting contributions in.
Yeah.
You're buying low anyway.
Yeah.
So we need to get out of our own way, stop listening to our friends, because you'll do your ass.
Yeah, and history's shown that to be the case.
And usually, most of the time, more than usually, when people react to short-term market volatility, their portfolio will reduce, then they will sell, and then it recovers faster than they can rebuy in, and they're still waiting for the bottom, and they'll be worse off.
Yeah.
So you've just got to call your super fund, speak to your financial advisor, understand the time horizon, and keep your mitts off your super and just focus on shoveling money into it. Well, that was a mouthful. Ron.
A breather after that.
Yeah,
we'll roll on to the next
Pete.
one.
Hope that was useful, and if it wasn't, well, it was worth what you paid for it. Ron. My wife has inherited the family home from my mother-in-law, who lived in the house from the mid-50s We've gone past the 2 years mark, so it's been in their lap for 2 years. If we sold what we can do to minimise CGT, if we sold now what we can do to minimise CGT, if we sold the old home and used the proceeds to purchase a new investment property, what would happen if we then had to sell later on or knock down the old home and built a duplex with the idea of selling one and keeping another in terms of the duplex? Wife is 66, I'm 71 and self-employed. A few things on the table there. Do you want to maybe talk, Martin, when we inherit a property, and we'll assume just for the sake of round numbers, do you want to just assume that the property is worth $1 million today and they inherited it 2 years ago and it was worth 900?
Yep.
Okay.
Sure. That works. Yep.
When it comes, at the end of the day, the ATO, the tax man, will get their money at some point.
They like to be paid.
They will get paid.
They will.
But when it comes, we'll talk to everyone about this 2 year mark that Ron's talking about.
So I think step one, there's a fair bit going on, Ron, and there's different options here. I do think you need some advice and to pay for an advice to explain these options. But yes, let's talk about some elements of this. So inheriting a property, is there any tax to pay the day I inherit that property? Typically, no. But may there be some tax to pay when I sell that property? It depends. In this case, the property is, mother-in-law lived in this property, so I'm inheriting a property that was someone else's principal place of residence. Those rules are different to if I've inherited someone else's investment property. So that's key to differentiate. In this case, we're inheriting a property that was someone else's home. Therefore, the cost base, the value that's been inherited at is the value at the date of death of mum. So mum's no longer here, we've inherited that property, that is the cost base. It's not what mum paid for it back in the 1950s when she first bought it. Am I paying a capital gain from then? No, the cost base is what I've inherited it for. The ATO provide and the estate rules and planning it that if you sell that in a ordinary course of time, typically that's up to 2 years, you can sell that and not have to worry about any further capital gains tax.
And the reason I think I said when they inherited it, it was worth 900. For all intents and purposes, the cost base for Ron or his wife
is the 900.
Is the 900. That's the floor.
That's the cost there. So the cost base is what's deemed to what you've purchased it at now. So, I haven't paid 900, but the value when they received it was 900. So that's your cost base. So if you sold that 6 months later and you sold it for 940, that's okay because you've sold it in this window, this 2 year window. But if you haven't sold it within the 2 year window, may you have to pay some tax on it? Yes. So let's say after 2 years you haven't sold that. Might you have to pay some capital gains tax on that? Short answer, yes. Now, you didn't pay $1 for it, but the cost base is the 900 you inherited that for. You sell it today after 2 years and 1 month, you've sold it for $1 million because that's its value today. You have made a capital gain of 100,000 between the million and the 900. That's what your capital gain is.
Or Ron's wife, because I would imagine the inheritance would have landed on her
in
only.
her name. It's not likely to be 50-50. It's likely to be completely in her name.
Yep.
Now, so good news is she's not paying tax on $1 million, but potentially in this scenario we're paying tax on 100 grand. Has she owned it for more than 12 months? Yes. So therefore she gets a discount. So that 100 is immediately discounted to 50,000. She would be looking at tax on that 50,000. Now, how much capital gains tax do you pay? It depends on what other income is in her name as to how much capital gains there might need to be declared. Ron's question here is there a way to minimise that capital gain? Potentially, yes. It's minimise other income that's in her name in that year. And his wife is 67. She would be eligible to make some concessional contributions to super to potentially reduce that capital gain.
So based on this assumption, if Ron's wife was still working, I think he said she's 66.
Yep.
And was earning 50 grand, so she might just do part-time or something like that. The total tax she would pay on her employment income is about $6,538. Mm-hmm. And then that $50,000 gain would drop straight
On
onto
top of
her
that.
income.
Yeah.
So I'm just going to put $100,000,
Taxable income then would, instead of being 50, would be 100.
which then her total tax based on that financial year would increase from $6,500 to $22,500.
Yeah. Yeah. So we're looking at then an extra $16,000 worth of tax. Now, we've just sold $1 million property we didn't pay anything for. So
Yeah.
16 grand's not that bad.
Yeah.
But we can potentially reduce that.
Now, one way to do that would be to, in that same financial year, let's see if we can put some concessional contributions into super.
To super. Yep. So the cap of concessional contributions each year is $30,000. So she could potentially go and put $30,000 into super, which would come off that $100,000 tax bill. Potentially her super balance is below $500,000 and she may have some catch-up contributions to do. Therefore, she could put even further into super as well that could reduce that tax. So when you put into super, it is taxed, but it's only taxed at the super fund tax rate, which is 15%, and you would save the tax in your personal names at your marginal tax rate. At the $100,000 threshold, the marginal tax rate for this financial year we're in is around 32%. Glen's going to calculate some figures to give that to us.
Well, what I'm doing is I'm just going to work out if we didn't do anything, there would be total $16,250 in tax. If we then went, let's put $20,000 into super. So then what we do, I'm going to put $80,000 in the normal tax calculator, but that $20,000 times 15% is the $3,000. So if we do
inside of the super fund, they would take out $3,000 of tax.
Yep.
But when Ron's wife goes to do her tax return, instead of having to pay $22,000,
she'll pay $16,388.
Perfect.
Plus the $3,000 into super, so $19,000
versus 22.
There you go. So
save $3,000.
$3,000, bush maths. That's a strategy.
Yeah.
And now I think, Martin, the dance is we've just used a wild assumption. The dance can be, well, if, for example, is it Ron's wife? Yeah, is 66 and she isn't working, that $50,000 would go straight on her tax return and there would be $6,500.
Yeah, the capital gain's not that much at that point.
Yeah.
And potentially then she could still put $20,000 into super.
However, and this is where, I don't know, correct me if I'm wrong because I'm happy to be, there can be a dance of putting too much into super and paying 15% in super where your tax rate out of super could end up being less.
Yeah, that's fair.
And that's a trap.
Yep. So marginal tax rates, they are margins. So the more you go down, you're going down the thresholds. At the moment, the cutoff, you're still paying 32% above $45,000 in taxable income. So anything above that $45,000 is pretty attractive, 15% versus 32. Below the 45, the tax changes come the year after, you're paying 18%. So 15 versus 18 is still a saving, but it's fairly immaterial to get that extra bit of bang for your buck. If you're getting yourself below 20,000, you're not paying any tax. So don't, again, back to the, if I've got a capital gain of $20,000, should I put that into super to pay less tax? Probably not.
No, because you'll end up paying.
You'll pay 15% versus you could have paid zero.
Yeah.
So there's an opportunity there.
So I think based on this, and this is why it's kind of fun to look at this, the CGT isn't your problem, Ron. It's more, what do you want to do?
How does this property fit into your retirement plans?
Do you need the income to live off it, or are you financially fine and it's just an extra thing? So let's have a look at some of these.
Yeah, we're not keeping or selling $1 million home over $16,000.
No. If we sold the home and used the proceeds to purchase new investment property, well, do you want to buy an investment property at 71 and 66?
How does that fit into your retirement plans?
Yeah. Do you want more wealth inside super if there is a chance? So that's a question for later on. what would happen if we had to sell it later on? Well, it all goes back to that cost base, doesn't it?
Yeah. So the 900, let's say we've kept it for 10 years now.
And it's worth 2 million.
Yeah. Then we're paying it for between 900 and the 2 million.
Now, what would happen if we knocked down the old home and built a duplex? Okay. One, do you want to be a developer at age 71 and 66 and the stress and all that?
And how are we funding that? Are we taking on debt to make that happen?
That's right. Or do you have a spare 700 grand in the bank over there? But just on that, Martin, regardless of whether if the property was worth 900 as the cost base, we bulldozed it and sold the block tomorrow for 700 or whatever, the cost base is still 900.
Yeah.
It just means there's a capital loss.
Yeah.
So having said that, if we knocked it over, spent 700,000, two premium little duplexes on there, sure, it could be worth 2 million. If you wanted to then sell one of the duplexes for 1 million, for example, this is where I'm walking into a complex trap here.
I'm with this still. So the cost base is 900. We've spent 700. So the cost base, if it is 1.6.
But we've got to, at some point, we've got to title the property and split it. And this is where it gets wild beyond the scope of my vibe. But if you did put a strata thing on it and you had the two allotments, or even if you got a Torrens title and a dual split, I would imagine the cost base would split and it would be 450 per allotment.
Yeah.
It all comes back to this cost base.
Yeah, and I think the other way any of these options are doable.
Yeah.
What is the right one to do? There's very different tax incomes or outcomes on all of these. What do you want to do? Do you want to keep this house as a legacy because mum's own it? No, we don't. Okay. Does the house in desperate need of repair? Do you want to do that work or do you want someone else to do that work? Are you just going to spend 50 grand to renovate it and then try and rent it out, or is it better off to sell to a developer who can knock it over and do all that work and take that reward but take that stress that you may not want?
One way to look at this, Martin, and I will say Ron put that he's currently self-employed and in brackets a farm. Like, what's happening with the farm? Is there people that are taking it over, like your sons and daughters, or are you like, oh, we're done with
sell that one day? Yeah,
like there's all these moving parts that unravel really fast. But sometimes one way I like to think about these thoughts, Ron, if you woke up tomorrow and the inheritance wasn't a thing, or it was CBA shares, let's do that. Ron woke up tomorrow and his wife's mum sadly passed, and condolences. Mum-in-law has left my wife $1 million, or we'll go 900. 900 in CBA shares. Cost base still applies, 900. Do you have a burning desire to go and buy another house, which, the fact that he's thinking about knocking it over and doing duplexes, it might be pushover.
Yeah.
Did you wake up this morning with the desire to, once we get this 900K, we're buying a knockover, we're going to do 2 duplexes.
We're going to go to the bank and borrow 700 grand and carry the stress.
We're going to become this. The answer's probably no, but what you've done is you've gone, we've got this house, well, maybe we should do these duplexes. Like, well, no. Like, think about it the other way. Back engineer it. Did you wake up tomorrow wanting to knock it over, wanting to turn it into an investment property, wanting to sell it and buy an investment property? I think you'll find that our mind plays tricks on us. And if we back engineer it, it's probably we end up in this thought trap because of the situation.
Just because we can doesn't mean we should.
Yeah. But if you're like, I've always wanted to do a duplex, and, my brother-in-law's a project manager at a specky company, and he said he would help, and we've got a contact in at council, and the state that we're in, the local government's got an incentive
to location's been perfect, or
cut
mum had
blocks in
started
half.
that process and we want to see it through.
Yeah, like I'm not opposed to it. I'm just like, well, what are we doing here?
Yeah.
So yeah, great question. Love that, Ron, and thanks for sending that in. We'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Okay, Martin, you little guy over there. You come up here into my studio. You've drank my
Drink all your water.
Actually, Lake Macquarie and Newcastle tap water is rubbish. So I grew up
Premium water.
I grew up in Wyong Shire, Central Coast. The tap water there, drink it all day long. Come up here to Newcastle.
You can even shower in it, I reckon.
You can shower in it. It's that good. Come up to Newcastle. It's got this weird smell to it. It tastes chlorine-y. Ugh, it's yuck. So I had to get a water cooler. And you know the funniest part? This is like the funniest part. Organised this company to come, water cooler. They set the water cooler up with the premium water in the bottle and
8 bottles, 6 bottles,
all that stuff. Drank it. I'm like, that tastes like crap. What the hell? So I called the company. They'd actually, the person who dropped it off, the truck person, accidentally left the alkaline added water, not the normal one. And I'm like having a heart attack, and I'm like pissed that off. So the owner of the business happened to come out. He's like, he tasted it like, nah, something's not right with that, and there's definitely not something right with that. He should have purged through the filter and the stuff. But anyway, Watergate. Oh, Watergate. Love it. But yeah, it's nice and lovely water. Alison says, it's been a long day. Can you read this?
Alison says, transfer balance caps and indexation, please. Also, can I please run this scenario by you? If we sold our PPOR, so principal place of residence, at 55 years old and put the sale proceeds as a downsizer contributions to super, so we could invest in an SMSF investment property for capital growth, or even just an industry fund returns while we caravan for 5 years. Can we just pull a huge chunk out of our super to buy a PPOR outright at that time, if the hubby's the only one who's then 60, and then I'm aware that we can only access his super at the time if he resigns, any reason not to do this? Okay, so there's a fair bit in this.
Let me now actually read it while you start to think.
So a few parts of this. If we sold our PPR at 55, can we put a downsizer in? Yes.
If both are over 55,
both 55, yes, correct.
And?
So have to have owned the property for over 10 years, need to put the money in within 90 days.
Yep. See, Martin, it's important.
And we need to have lived in it.
That's right. It's important we always don't assume that everyone knows the rules.
And always listen to all of our quality podcasts that we've been putting out. If you're enjoying this, there's plenty more to go back and listen to.
There is.
But yeah, good point. So yes, if we're both 55, we potentially can do that. Because the reason, I guess, summarising another way is we want to sell our home because we're going to caravan for 5 years. So why would we leave our home there? Let's go and put that money to work while we're travelling for 5 years. Is the strategy being considered with the view that once we're back, let's say that we've turned 60 years of age in one day, we've now finished the caravan trip, we're back to where we want to live, and we've decided at that point we now want to rebuy a home again. Can we take that all back out of super?
Yeah, I love these questions because I genuinely love these questions because someone, they're 55, they've obviously done well, they can buy the caravan, sell the property, let's live the dream.
Go and live our life, and yep.
I love that. And it just, I love that. And I love that you're thinking, Alison, about very strategic things. Because there's so many people, Martin, that we see they'll write in at age 65, we've done this for the last 10 years. Like, why the hell did you do that? Yeah. Couldn't you? The thing I would say is, I don't know, it's hard because we don't have crystal balls and whatnot, but ideally, in 5 years' time or in 3 years' time, if there was a family emergency and you had to cancel the trip short or whatever, would you want to move back into the home that you've got now or even the same area? And I think the reason I say that, Martin, is if the answer is, oh, yeah, we probably would want to live back at the home, well, we need to make a lifestyle decision, not a financial decision. If it was, well, we want to, sell the bastard, whatever, we're going to not own a home for a few years, then we're going to move an hour away to be closer to the kids or something like that. Yeah, sure. If the going's good and you don't want to be a property manager while you're traveling the world, sell the bastard. Or if, let's see what it will get per rent, leave it rented because we've got that 6-year rule, which we can talk about. Rent the bastard out and even make it so when you are coming back, once the tenant's been in there, and if you do want to continue there, throw 60 grand at it, new carpet, new paint, freshen it up.
Make it feel like back to our home again. So
maybe touch on the 6-year rule and why it's worth considering in the back of our mind as well.
Yeah, and I think to answer Alison's question, could this work? Yes. There are certain limits and rules and timing, etc. So could it actually happen? Yes. Do I think it is the best way to go about it? Perhaps not, because of the transaction cost in and out and the market risk, and are we out of the market or the property sector, and if things change after you want to come back, we can't access super generally under the age of 60. So we've done this at 55 with a great game plan, but life can change along the way. As you've said, we might have snookered ourselves a bit. The more conservative way to achieve this is, like you said there, is, well, let's go do the trip, but let's keep the house. What does that look like? So as you mentioned, can I rent the house out when not living in it? Yes. So find an agent, get an appraisal. Yep.
You're only do 6-month leases. So if something happens,
you can change
4
and come
months
back.
in, it's like, all right, we'll come back, live in the van in the area. Then in the 2 months,
then we find, let's say that we might get 40 grand a year of rent, joint names, 50-50 each, $20,000 with no other wages, etc. We're probably not paying much or if any tax on that. At least we've got that rent coming in. Now, is it investment property? Well, maybe depends how you look at it. But so from a rental side, yes, as investment property, you've got to pay tax on that rent. But from a capital gains perspective, there's a 6-year rule. Now, that rule is if you own a principal place of residence and you leave that property for a period of time to travel, rent another property somewhere, there are actually rules where you can buy another property and treat one as your principal while you're living somewhere else, that for up to 6 years, you can not declare that as your principal place of residence, even if you're not living in it, and therefore it's exempt from capital gains tax. So i.e., we leave today at 55, it's worth $500,000, we're renting it for 5 years, we come back in 5 years' time, it's now worth $900. Can we turn around and sell that and not have to pay tax on it? Yes, as long as you've met those conditions the right way. That's how that 6-year rule can come into play to still give you that some control and certainty around you own a property and you're getting a return on it from a rental side of things, but you're not causing yourself extra tax headaches.
Okay, this question, Alison, it's the gift that keeps on giving. I love it.
But wait, there's more.
There's more. I've got some steak knives here, Martin. And I was just reading, I think we maybe asked somewhere, does anyone have any questions? She's put transfer balance caps and indexation, please. Also, then this question, the next question is about balance transfer caps because the producer of this show is really good at how they put this together. And I hear he's a great looking young man like myself.
Oh, you must have met them before.
There's a big thing that we brushed over, which we should have flipping smashed that emergency brake glass button. The last thing I would want to doing if I'm on the road for 5 years is having self-managed super fund.
Oh, yeah, and investment properties inside of it. Yeah.
So that's number one. Number two, you can't... Sorry, no, I'm just trying to think. There's a lot going on here, Martin.
It goes,
So wait. Number two, similar to the last question, did you wake up this morning saying we need to buy an investment property inside super with our money? Homes always go up in value. We've just got to do that. To be fair, she said even just an industry fund. So number one, if you did that, it's going to cost you probably 20 grand just in stamp duty because you're going to buy a new property inside the super fund. You'll sell your property, which is probably 15 grand in agent fees. That's a good way to throw away 50 grand.
And I think defending or complimenting Alison, I think she's thinking, which is where these questions are
And that's
good.
what I love this. And Alison, thank you.
And that's back to your, what's the plan? If the plan is we're not going to return to this town or suburb, we're going to sell the house, do I leave that cash in the bank for the next 5 years? No, I've got to put it to work. Okay, maybe I put it in an industry fund. That's maybe not correlated with the property market. Maybe I put it in investment property for the next 5 years. But that definitely has some hairs or scary bits about it. But I suppose that's a common going, well, at least I'll be in the property market. If the property market booms, I'll still have some property. But maybe we've kept the principal place of residence because that's still going to be a tax-free property asset anyway.
Mm-hmm. Another thing here, Martin, it still sounds like there's a mortgage on the property. So only because she said to buy a PPOR outright after we pull money out from super, the more I think about this, Alison, also get advice, I'm not your guru and all that, the more I think about this, buy a caravan, put a tenant in the bastard, the tenant can pay for the holding costs, get on with, go and enjoy your holiday, get a rental agent,
if there is
kick
a mortgage,
the can down. If in 5 years when you come back, the interest is tax deductible.
Yep.
Get it valued the minute that you turn it into an investment property. Because you need to reset the cost base.
In case you're not back within 6 years, yep.
Or in case you get an inheritance and in case Alison Ron's your husband from the last question and you didn't realise your mum left you 900 grand, all that stuff, that's what I'm doing. And then get the value so the cost that's what I was going to say. If you inherit money or something comes out of the blue and you decide, we'll just keep it as an investment property, later on down the track when you sell it, you've just got the cost base, then not from when you purchased it. So it's a hedge the bet.
Yeah.
And I will just say, I think while I'm so wild up, when I had lunch before, on a big afternoon, I had a little Ritalin tablet to keep me dialed in, and I get really dialed in. So I think that's what's happening here.
Yeah. No, and I think Al's on the right path. It probably is personal advice. They're going, well, let's pay an advisor to run you 3 scenarios, and then you decide. There's no right or wrong answer here. There's definitely some complements to the strategy, but I think there's a lot of cost of ins and outs and et cetera and uncertainty. We might plan to travel for 5 years, but we might not. And I want to come back at 58 and have all this money tied up in super that I can't buy a house with.
Yeah. My other question to Alison, what are you living off while you're driving around with the caravan? Is someone working remotely? Is there other cash, or is there like the PPOR's worth friggin' $3 million and it's in Mossman and we're gonna
it's gonna be money left.
We're gonna put 500 grand in a bank account and live off that for the. So I love this, but my initial thing is, one, get advice, but two, we're definitely not doing self-managed super fund, actually, self-managed super funds. I'll tell you something after we press stop about what happened in my audit.
Ooh.
It's just a bit of a teaser for everyone out there. I had my annual audit. We passed with flying colours.
Very good.
But I will say, the auditor queried something.
Okay. And they're entitled to do. Yes.
That's their job.
Yes.
But they were categorically wrong and shouldn't have queried it.
Oh.
So that's what happens when you have outsourced people. I'll leave it at that.
Right.
We'll leave it at that. All right. All right, Michaela. Investing in retirement outside super to retain capital and or if you have reached the transfer balance cap. We must have put a thing up somewhere, like if you've got any questions for the show or the email in.
Topics, etc.
If you do want to email questions for the show, retireright.com.au, put the question in there. If you want it to be anonymous, just say anonymous, please. And then the team, Rach and Jess, they put it on the question bank spreadsheet. And when we prep these episodes, we just grab them. Don't fill out that form and say, "Hi, Glenn, what should I do? I've got this. Can you let me know?" Because I can't give personal advice via email because there's a million things that we don't know. But I can take your question and we talk about it here just as
pros
fodder
and cons and
pick the meat off the carcass on the side of the road type vibe is what we like doing. So, yeah, that's what basically Michaela said. So before we get into that, Martin, just refresh us on what the transfer balance cap is.
This is fun. So
the wording of it isn't great.
No, I'm going to give you two acronyms. So TSB stands for Total Super Balance, and TBC, not to be confirmed later, but Transfer Balance Cap. Now, these are both measures, not rules or limits, but these are both measures to do with your superannuation. So transfer the TSB, Total Super Balance, that's a limit that refers to what type of contributions I can or cannot do. So we talked about the 500,000 limit for carry forward contributions. That's got to do with your total super balance, your TSB. Whether you can do certain non-concessionals once you get to a high balance of super of 1.8, 1.9, $2 million, can I still put more contributions in as non-concessionals? That depends upon your TSB or your total super balance. So that's a important measure to understand. Somewhat connected to that, because it's actually the same figure of $2 million at the moment, is what's called your transfer balance cap. And what that's got to do with is once you've got the money inside of super, the transfer balance cap is when I move it from my super accumulation to my super pension or account-based pension, when I start to take it as an income stream out of super. So, i.e., I've got a balance of my super fund of $500,000. I've been working for many years, and I've decided now at 65 I want to live off that. Contact my super fund, fill in some forms, and I move it into a pension within my super fund. What would happen on that day is your super fund would tell the ATO, "Hey, Glenn started a new pension. He's moved $500,000 across to pension fund," and they would count $500,000 towards your transfer balance cap.
Okay. So this has recently increased from 1.9 to $2
million. So that is a limit per person around how much you can move across into pension phase. And I chose my words correctly there. If it's not a limit of how much money you can have in pension phase, it's how much money you can move across into pension phase.
I roll my pension back of that 500 to accumulation to offset the cap, to reset the cap back to 2 mil?
You can
ish.
Let's use that example. So,
the 2 million cap with 500 transfer.
A year ago, let's do it this way. A year ago, Glenn set up his new pension with 500,000.
Yeah.
The ATO have gone, you've triggered that 500,000.
Of 1.9.
Of 1.9.
Yeah.
So then let's say a year later, you've gone, actually, I'm going to roll that back. If you roll back 500,000, well, then they cancel each other off. Your transfer balance cap back to zero.
Yeah.
If you roll back 550, let's say your fund's gone really well. It's grown. Yes, you've taken some pension out, but it's grown. You roll back 550, your transfer balance cap is actually minus 50 in a good way.
Right.
You can actually put more. Now, technically, you could start a new pension with $2,050,000.
Right. Yes.
You've moved more credits back. It's like a credit.
Yeah, okay. So it's a debit credit system. Yeah.
If you did accounting in school.
Accounting,
Oh, yeah. And it's the ATO.
What did I did that course at uni, one module, debit the credit.
Yeah, okay. Get out your green. If you want to do auditing, that's your green pen. So that's that element. Vice versa, I moved 500,000 across and I've drawn heavy pensions or my investments haven't gone so well and I moved 400 back. Well, then you've actually still got a balance of 100,000 because you've moved back less than what you put in. So that's how they count your debits and your credits.
So to be 100% clear, I could start a self-managed super fund tomorrow with $2 million in accumulation, or $3 million. We'll do $3 million in accumulation. Mm-hmm. We're not paying Div 296 yet. Mm-hmm. I can then move, because I'm over the age or 60 or 65 and not working, $2 million to a pension account within the self-managed super fund.
Yep.
Purchase Bitcoin or a crypto asset with my self-managed super fund of $2 million. That $2 million can grow to $10 million no problem at all because the
growth.
gate is the 2 million.
Correct.
However, a lot of people then say, well, what happens to that $1 million? It just stays in the accumulation and is internally taxed at 15%.
Correct. Yep.
Okay.
Yep.
That's cool baseline.
Doesn't have to exit the super system. It stays in accumulation.
Yeah.
And so, using that example, extreme example, but yes, that's how those mechanics would work. Let's say you revert that 10 million back to accumulation. You would then have a minus $8 million balance, which is very attractive. Let's say the opposite happened. You bought your Bitcoin and it's gone to zero.
Or $1.
Let's go to $1.
Yeah, $1.
Let's go to zero. It's gone to zero. Oh, okay.
You can't commute a $0 back.
No. So then you go, okay, well, hey, an accountant or hey, advisor, I've got $1 million in accumulation and I don't have anything in pension phase. Can I move my $1 million now into pension phase?
Oh, yeah.
No, you can't.
No.
You've used your limit.
Trigger, yeah.
It doesn't matter if you.
But if the Bitcoin went to $1, I move $1 back, then go, yeah, you can move $1.
$1,
over.
yes, correct. You could move $1. So that's why it's not a limit about how much you can have in pension phase. It's a limit about how much you can move into the pension phase limit. So for many people with $500,000, $800,000, even $1 million, it's not a big thing to worry about too much. On your ATO portal, you can actually run a report that shows your transfer balance cap and all the transactions that have occurred, the ins and the outs. When you take a pension payment, I take $5,000 a month as a pension payment. Does that affect my debits or credits? No, it doesn't. Pensions don't. However, if I take an ad hoc lump sum payment, I've taken $50,000 out to upgrade the caravan. As long as when I send in my form to my super fund to take it out, they'll say, do you want a $50,000 additional pension payment?
No, we want to commute.
I want a $50,000 ad hoc lump sum or a commutation. That extra $50,000 will give you a credit back to your transfer balance cap. Mm-hmm. And that's important that on that day, I don't have another $50,000 to put across. It's never going to matter. But I would still tick that box because
who knows what's
around the corner kind of thing. So that's how those
Yeah, so that's really
mechanics.
important there when you've got a superannuation account-based pension or income stream. When you are taking money out as a lump sum, there are, some weeds. Is it income or is it a rolling back to accumulation?
The value of that tick on the box, because being extreme, I'd had $1 million in there, back connecting to Alison's question. I want to buy a new house, I'm going to take $1 million out. If I tick a pension and then I decide later I want to start if I tick I'm taking $1 million out of my pension fund to buy a house, I then want to start a new pension and set up a new transfer balance cap transfer. You might not be able to do that because you've ticked the wrong box on a form, as simple as that sounds. So there's some ins and outs before we get to the indexation side.
Yeah.
But
and then I'm just thinking, and everyone, the reason I use such extreme numbers is because I really want to try and explain the concepts, because I think a lot of the time if we understand, I think in my basic way that I learn and understand, it's like once I understand the concept and that rock solid analysis of the concept basically, the penny drops. So if we had, for example, $2 million in super, we moved $1 million over to pension phase, and then the other account moved, so that means that there'd be $1 million in pension and $1 million in accumulation. Mm-hmm. The $1 million in accumulation grew to 1.5. We withdrew the $1 million, spent it, holidayed it, whatever, and there was 500 left, for example. We know that we've triggered $1 million. Just so I'm clear, if we did the $1 million over before the index, are we punished at all, or we just, at the time, the index is now this, the whole boat gets lifted? Does that make sense?
It does.
Is that $1 million that I did before the index, is that quarantined on a pro rata base on the old index? Am I making any sense?
I think the answer is yes, it's proportional.
Yes. Okay. So we've got $1 million in super, $1 million in pension. we took out $500,000 out of the pension account because we want to
pension payments.
pay the mortgage off
Yep.
or whatever, well, then you'd probably would you commute? No, you wouldn't because you'd needed it. So then the other super account grew to 1.5, and then like, all right, tools down. I want to start working again. You would then, and this is more of a housekeeping thing, you would roll back that 500 that's the account's reduced to into super, which means we've netted off 500 of the transfer balance cap.
Yep.
So now we've got 1.5 million
Available.
because we've offset half of the million that went. So now we've got 2 million back in accumulation. It just means that when we start that new pension, we can only take 1.5 million over and the 500 has to stay.
In accumulation.
Or you would do it, well, let's just take 1 million over to pension and start a pension with 1 million and have the existing 500 there.
Yeah.
Because I think what I'm also saying is you can have 2 account-based pensions or you can roll it back and reset
combine them
it
into one.
and have one.
And if it's an SMSF, you can have plenty and it all sits in the same pot. If it's with a wrap account or an industry fund, often you've got to have actually separate account numbers and separate balances there.
But yeah, so this can get, when you are at those caps, like Michaela's talking, we'll get to her question now because we have to build a baseline of what stuff is. So basically, she's in a potential, has $2 million in super. Well, now investing in retirement, outside super to retain capital, and if you have reached investing in retirement outside super to retain capital, what's she saying there?
Yeah, I don't quite get. I think it's, I suppose, a hierarchy. Let's say I'm 66. So all things on the table.
Keep talking, I'm just going to turn this aircon on.
Where's the best place for me to invest? It's in my account-based pension. If I'm 66 and retired, I can have, as the rule stands today, up to $2 million in pension phase, no tax on my income, no tax on my rent, no tax on my capital gains, and no tax on those withdrawals. So that's number one. What is the next best place for any surplus funds to sit? Often it's accumulation because you're only at 15%, or personal, it depends on how much it is. Because why I've said accumulation first is money inside of super in accumulation phase is taxed at 15%. Now, that's a pretty low tax rate, arguably, and it's a flat rate of tax. Doesn't matter if you've earned $1 there or $1 million there, it's 15%, ignoring the new Div 926 tax coming in. In my personal name, the first $20,000 give or take I earn, I'm not paying any tax. But above that, it starts to step up at 18%, 32%, 39%, 47% in tax. So if I'm looking to have another $500,000 or $1 million invested, 15% tax isn't too bad. In my personal name, maybe I'm paying the same amount of tax, maybe it's less, but often it might end up being more, particularly a compounding capital gains impact into the future in that regard. So from my perspective, in most cases, it's pension first, accumulation second, personal third. It depends is if we're only talking about 200,000 or 300,000, it's probably personal would trump accumulation in that regard.
There's another thing, and I'll give you a push-pull comment or whatever, like a compliment and also a slap, that particularly online and the nuance of questions, like there's a huge element that people don't consider with all this crap, and it can trump a lot of these strategies.
Yeah.
Can you think what that is?
Well, is it an IB?
Yes-ish. We'll get to
Okay.
what that is, but like as a broader consideration. Geez, the time is excruciating. The suspense.
The asset class?
No, like broader consideration for somebody's wealth.
Estate planning?
Thank you. We have a winner.
Right. Yeah.
We have a
Okay.
winner.
I suppose solving for with, yep.
And I think, for all we know, Michaela could have stepchildren in a blended family.
Yeah.
And if that's the case, what the hell is happening when you and old mate fall off the perch? And in your own name might be a real terrible idea outside of super. It might be better to put the money in accumulation and have a binding beneficiary to an adult child, even though pay a little bit more tax.
Yeah.
Question, if someone had the balance transfer cap of $2 million and they set up a pension tomorrow of $2 million and they had the $1 million or $20,000 in accumulation, you can contact the super fund, and while the products won't allow you to do a regular payment, but you can ask for a withdrawal just from the accumulation.
Yeah. And so I've got clients like that we've maxed out their transfer balance cap. They've got the most of it in pension phase, and we might have 20 grand or 500,000 in accumulation.
Because there's no limit to how much you can have in super.
Correct. Yeah. So
there's an elephant in the room that everyone's thinking about, but
yeah, and that back to there's a how much can you put into super? That's your total super balance rules. How much you can move to pension phase? That's your transfer balance cap. But yes, there's no limit about how much you can have in, just what tax you might pay on that. So therefore, those clients I've got, they might be getting a $10,000 a month pension, but when they want to do that trip or upgrade the car or give the gift to the grandkids, we're not taking that out of the pension fund.
No.
We're doing an ad hoc commutation or lump sum withdrawal from their accumulation fund.
Yeah, and they would just tick the box to the trustee that I'm over 60 and not working, or
take
over 65.
Yep.
Yeah.
And
And that's because that goes back to the product design where there's no super product that I know of that you can go, oh, I'm over, here's my accumulation account, I'm over 65, can you drop $1,000 a month into my bank account? Like it's just not happening. It's got to be a lump sum withdrawal.
They're not meant to look like a pension. So you might be 2 years you've taken nothing out of that, and then the other year you might take out 3 payments in over the 12-month period. There's no rules or limits about that. It might be hard to put it back in, but that's why that kind of setup can be appropriate. If it was the 20 grand, you can leave it behind. Often in that case, I would say to that client, let's take the 20 grand out, just put it in the bank account.
Yeah, and get on with our
leave
life.
it there. But we don't need the other account open and pay the admin fees and investing 20 grand. But if it is more substantial, hundreds of thousands of dollars or more, the accumulation actually might be the best place for it.
Before, and we do need to wrap up, far out, before we press record, I'm like, this will be a quick 35-minute because I wanted you to leave here at 3 o'clock.
We get excited. There's lots of things to talk about.
Yeah, gosh. And I'm only just getting going because I'm not a morning person. My prime time's like 2 to 7 p.m. And I had some help before this episode. So that's why we're dialed in, baby.
Yeah. Get ready.
And this is, you mentioned IB before, which for those playing at home, it's an investment bond. And I've always said that it is the only product that I think, and the only structure where the pendulum swings the most, like really, really good for a situation, or the other way, really, really not good. It's the only one I can think of with the pendulum that swings the most. So having said that, when you are doing all this planning, the estate planning has to come into play as well as the tax. Then we look at structures and how much we need. And, the investment bonds could be good if you're 60 years old, you're printing money, you've got some grandkids. Yeah, we'll throw 30 grand in a bond each and get on with our life.
Set it up, yep.
So,
yep.
And then that suits. But you get people online, oh, investment bonds are so crap, and blah, blah, blah. It's like, whoa. You may have got the wrong product for your situation.
Yeah. Yeah, and back to what are you trying to solve for investing outside? I've got a client that comes to mind that we've got the maximum pension phase. She wanted to get below the Div 296 threshold, so the option was, we'll put it in your own name. Oh, I'm going to have to pay tax returns again. I'm going to do tax returns again. Well, yeah, you will. I don't want to do tax returns. What's another way that I can still keep this invested but not have to go and see an accountant every year and get all my data together and sign a thing and pay it? Well, we could look at an investment bond. And I did the maths. I'm like, you're probably actually paying a bit more in tax at that potential investment bond tax rate, given how little is in your name otherwise. But the convenience of not having to pay for a tax return to be done, not having to collate all the information together. Remember to do that in your 70s, let alone later in life, do we want to be helping mum or dad at 87 do their tax return when it could have been sitting in an investment bond that's going to go tax-free to the kids?
And sits outside of the estate, so it can't be challenged.
Can't be challenged. It's not going to get tied up with probate for as long and different reasons like that. So, yeah, back to your point around tax isn't the only and the main focus with that kind of thing.
And neither are investment fees. We'll leave it there. Just what's coming up on the show over the next couple of weeks. We've got Nathan Fradley popping in. We're going to re-record the episode. How much do you need to retire with the age pension? Then another episode. How much do you need to retire self-funded? And then I want to chat with Martin. I forgot to reply to your text when I text you. I'm going to do another episode with Martin or somebody on annuities and do another deep dive. Full disclosure, I want to see if I can get a company to pay us to sponsor that episode because I don't work for free and neither should you, but we would never have any products that we take money from that aren't suitable to people. And that's it. Like if I got money out of an investment bond provider, it doesn't mean investment bonds are the best or the worst for somebody. It's just not every product is for everyone.
Yeah.
So I'll make money as legally and as ethically as I can.
And importantly, transparency.
And transparency. I'm big on transparency. And so look, if I can't get a sponsor for the annuities episode, well, it's just going to be me and you, Martin, and they probably might get a free ride anyway because there's only a few tickets in town. But I just want to try and optimize and help fund this to pay for the team and everything that we do. So appreciate you listening. If you found this useful, please send it to a friend or family member. We're on YouTube. There's a playlist. If you just listen to this audio only and you want to have a look on YouTube, just search Money, Money, Money Glen James or Retire Right. It's a podcast feed within the Money, Money, Money channel. So Martin McGrath, thank you for joining us today. And
thank you, sir.
We'll see you soon. Bye.
Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.